I wanted to touch a little bit on behavior because you spoke about that a couple of times in your answer. And one of the tendencies all of us have who build these quant strategies is to want to build, the highest factor loaded strategy, the strategy that produces the best return over the long term. And then as you do it, you realize, wait a second, like I'm putting people in this and they're having a really hard time sticking with it. And I'm wondering how you strike that balance, because on one side you have this highly loaded factor strategy, and on the other side you have maybe the S&P 500 slightly reweighted. And how do you find the space in the middle where you can have the strategy that has the factor loadings, but people can also stick with it?
That is such a timely question because we have found over the last 10 years, really kind of since when we started O'Shaughnessy Asset Management, we were having a research meeting, and it dawned on me as I was listening to my colleagues that I had designed all of our original strategies for me.
Nice.
I am a risk-seeking, I love risk. So I, had a mental block there. Like, why wouldn't you want something that is going to do over 10 or 20 years, 1,000 basis points better than the benchmark? Of course you would want that. That's the rational choice. Well, that was, I wrote a paper, Mistakes Were Made and Yes by Me. I can add that one to the list because as the fiduciary who is designing strategies, and you guys are in the same boat, what we really have to find are strategies that do better than the market over long periods of time, but that investors can actually stick with. Okay? So that takes a lot of really interesting strategies, to people like us, off the table, because they do incredibly well if you are Rip Van Winkle and you don't look at the portfolio for 10 years, you'll wake up really happy. But that isn't the way human beings are. Some people look at their portfolios daily, hourly. It's horrible and toxic to your returns. Lots of academic studies back this up, and yet human nature, right? You're never, ever going to overcome human nature. I say that's the last sustainable edge, arbitraging human nature. So for a quantitative factor investor, what we have to strive for are portfolios that take maximum advantage of the anomalies in the factors, but also keep a keen eye on downside variability. In other words, everybody, right? Don't look at standard deviation of return, right? Because that includes up and down. When stocks are going up, you want the highest standard deviation you can have, right? It's only when stocks are going down that people freak out. And so you can look at the downside risk. You can look at all of those things. How often, what was its biggest maximum drawdown? All of those became much more important to us as we evolved our strategies. And so I think what you see us offering today are portfolios that very much take that into consideration. These are portfolios where we're still trying to do the best in generating alpha, but in a manner that doesn't create, a wild, wild ride that people simply can't hold on, right? And so we're taking our understanding of human nature into account and looking for those sweet spots where we're paying attention to financial strength. We're paying attention to quality. We're paying attention to all of those things and excluding companies that might have a great potential upside, but also are so volatile that when that bad volatility hits, and note, I say when, not if. You're deluding yourself if you think you're not going to have drawdowns. Everybody has drawdowns. Right. And so the advantage to being a systematic investor is we can look at how bad they were. And sometimes they're very, very bad. What we try to do now is marry the best alpha that we can find to a drawdown that we feel that our average client, and I hate that word because we don't have an average client, right? Everyone's different. Everyone's interpretation of risk is different. All of those things need to be taken into account. But in the absence of doing something specifically for Jack and for Justin and for Jim, which we're getting closer to being able to do, but that's another story. You want to say, okay, can somebody with a normal reaction to a market loss stay and stick with it? And what we're finding is that, yes, as we've evolved our portfolio strategies, taking the risk that they face in the market into account is part of the process. And when I first did all of our original strategies, I was in my early 30s and loved risk. And then I had the enlightening awakening that most people don't love it. Most people hate risk. And that's why you see, unfortunately, the risk aversion anomaly where they hate risk so much that they need a lot more upside than downside. And markets don't work that way. So the answer is, you're absolutely right. You need to take it. Anyone who's doing factor investing or designing portfolios, whether you're doing it for yourself, whether you're doing it for others, you've got to take that downside seriously, because if you think that you can take a portfolio that's down 60% when the market is down 40%, maybe very few people can do that. I know a couple, but most people can't. And so you need to acknowledge that, and you need to design a portfolio where that doesn't happen.